The following is a presentation of TFNN.
Welcome to today's September 12th edition of Celestial Charting, folks. And the next one's going to be 2 weeks from today, September the 26th. The things that I'd want to be able to cover with you today, I want to cover with you the current lunar and astro cycles, the ones that are currently on our horizon. I want to go over with you the relative strength indicator, RSI, but I want to use it here. I'm going to show you how to utilize it as a tool from when you see divergences in the marketplace. So you can use it on any time frame, and so we'll go over that. Specifically, we're going to take a look at the crude oil setup, and I want to take a look at also a box trading range on the crude oil setup for those of you that are intraday traders. There is going to be an opportunity. You'll probably need to have quick fingers either to play the UCO or SCO, but we'll take a look at that. I want to take a look at the general market action today. Right now, we have really a very flat market out here. My expectation is that the market will move down into Friday. And I would, so that's the current thought process. We'll see if, in fact, that's the case. It is the primary reason that I've put the number of trades that we've identified, which are quite a few, either momentum trades or confirmed AB equals CD up trades, and want to pause until we see what how the market responds to the Fed, and hopefully what we see is that the market moves down into this coming Friday, where we'll go ahead and take some of those trades. We'll take a look at our current trades that we have. We were stopped out of Panera Bread today. That has turned from a sell to a buy, actually, as it has taken out resistance areas, and it's done it with conviction today. So we'll take a look at our current trades and then any Q&A. And feel free to type in some questions. You guys were typing in things. It was at the beginning of the seminars or the webcast, so I wasn't really paying attention, but I will be paying attention now. The last lunar phase that came in for us was apogee. You see that on the ES mini charts that are included inside the newsletter. Here's an updated version. If you haven't utilized this and you do trade intraday, you certainly want to be aware of apogee and perigee. You basically are looking for, as the market is either moving through it in one direction or the other, and you want to be short if price is below, especially if it's coming through with conviction, and then you want to go ahead and be long if price is moving up to the upside there. But it's very helpful to be able to use. It is not a swing point, but for some strange reason, it works much more often than it does not work. So very good to be aware of perigee and apogee. The next lunar phase that is coming in is on Sunday, which happens to be a new moon. And back on the perigee here real quickly. The time that is listed here is 5:56. That is ephemeris time. So for Eastern Standard Time, you would go ahead and you would back it off by 5 hours. In this case here, 56 past midnight. And on is that Friday? Yeah. Yes, 56. Yeah, on Friday morning. So 56 past midnight on Friday morning. And you would go ahead and actually place that, if you're using a 10-minute chart, at the close. In this case here, you probably would use the close at 1 a.m. So that is on perigee and apogee. The next lunar phase is the new moon that's coming in on Sunday. And so I suspect that what we'll see price moving down into Friday. So maybe towards the end of Friday that would be put in on trade. When you have a lunar cycle that takes place on a weekend, you're never sure if it is Sunday or Monday. We'll just look for some patterns that would set up should the market move down into those areas. The last lunar phase that we had was August 31st, which happened to be the full moon. Market was traded in a very tight consolidation, but we can see here is that it certainly acted as a low, and we had prices, move up, and in fact, take out some resistance areas with conviction. So that's the good news. When you take out a resistance area, it becomes support, and in essence, that's what we're looking for here from any trades that we would take a look at entering as the market would be pulling back here coming into tomorrow or most likely Friday. The next lunar cycle after that is going to be perigee, which is going to be next Wednesday. So a week from today, that's 2:44. So you're going to want to, on the ES Mini, you're going to want to go back to Tuesday evening, 5 hours. That would make it, boy, this is going to be a test. This would make it, 10? This would make it 9:44. So 9, 10, 11, 12, 1, 2, yeah. So 9:44 in the evening is where you would want to mark that line on the chart. And if you're up trading the ES Mini, you can trade it right then and there. If price is above it, you can be long, and if price is below, you can switch to a short position. Paper trade it for a while if you've never done it. And then after that, at the end of the month, on September the 30th, is the next full moon. So that's on the lunar cycle. We also have one remaining P-index date in the month of September, which is the 24th. So on 24th, we would expect to see some type of trend change. As far as major aspects, the next major aspect that occurs, and I'm including all of this in the newsletter for you folks, is the next Venus-Uranus, which is September 13th. That would be tomorrow. Trine itself, which is the mathematical geometry angle, typically has a positive relationship with regard to the market. These are the major aspect angles that we take a look at that are included as there's planets aligned with each other, and trine is the 120 degree mark. But what we spent a lot of time last week, 2 weeks ago in the session, taking a look at that, and so I won't be spending much time on that really during this trading session. If you did hear, or training session, if you didn't hear that information, go back to the archive if you would and take a look at that. This is the major planetary alignments when you have two planets that are in conjunction with each other, conjunction being at zero. You can take a look at this table here, and this gives you the typically what one would experience, either bullish or bearish, when you have those alignments. And again, all this is included in the newsletter here. And these are the type of, when you have certain aspects that align with each other, these are the typical markets that they simply have impact on. So that was Venus and Uranus. The remaining Venus-Uranus aspects, we've got one in November and one in December as well. So let's go take a look at the relative strength indicator, and we're going to also take a look at light sweet crude here. So let me go ahead and put that chart up on the screen. We'll switch over to this. And again, the way that I want to be able to share and show this indicator, it's used by a number of, it's got a number of different techniques to use. Actually, before I do that, let me give you a little bit of the background on it. So let me go back here to the chart here. Make sure I've got it in here. So what I want to do, the relative strength indicator index was developed by a guy named J. Wells Wilder, and he is a mathematician. He published information on this back in 1978 in his book New Concepts in Technical Trading. It's still available. It has become really one of the more popular oscillator indicators that are out there. Now, if you take a look at what might be set up in your software, there is a possibility that what's set up in your software is different than the way that he uses it. Basically, the primary thing that you want to do is go back and take a look at the smoothing out, the moving average, the exponential moving average. There should be a little tool within inside your software that would allow you to go ahead and change it. I'll show you that when I pull up the Ensign Windows software. And what we're going to be paying attention to is really levels above 70 and below 30, which are strong indicators of either market reversals for overbought or oversold conditions out there. Again, this indicator can be used for plenty of other things. I want to show you how to use it when you're taking a look at divergences out there, and then associate that with candle patterns. So put those two together, and you can take a look at that for any equity, any stocks, indices, ETFs, anything that you might trade, and add this to your arsenal of tools. And it's really that divergence that I think is one of the best ways to be able to use this indicator. So that's so we'll go. Let me now switch over to the chart. I wanted to give you at least a little bit of background on that. So we're going to go take a look at crude oil And what just so happened that when I was taking a look at crude oil, one of the things that I wanted to review with you folks today was really the sideways box action. And as I was putting that together, I went ahead and said, well, let me see if there's actually any divergences using the relative strength indicator. And sure enough, there was. So it was kind of nice to be able to do two things at the same time. So I will come back to the sideways box consolidation, but you can see that that we have had light sweet crude travel really since the August 23rd. So it's now over 2 weeks where it's been in a sideways consolidation, what I'll call sideways consolidation range or box. The high of it is 98.29, and the low of it is 93.95. So there's a $4.34 range that this has been traveling in. When oil breaks out of this, it will go about $4.34. Got to give it, a little bit of room, but let's just call it $5. It'll go $5 in either direction once it breaks through. There, and so. Folks, those of you that are intraday traders, I'd be paying attention to it, watching for that break. It doesn't matter to you which way it goes. Then you would have the opportunity to play the USO or the UCO or the SCO, I think are the two ETFs that would be out there. Now, so we'll come back to that in a moment, but let's take a look at the RSI, relative strength indicator, and how to use it for divergences. So, it's showing momentum. Oh, and now what I was going to also do is let me go ahead and pull up the actual indicator itself on the chart here. As soon as I can find it, relative strength. Okay. So what you're basically taking a look at is the number of bars or the look-back period that you want to use is going to be 14. So that way, on your tool, you're going back and you're taking a look at 14 bars or 14 days or 14 periods worth of information. In the case of the tool that I'm using on Ensign, I'm just selecting the number of bars, so that's helping to identify the smooth average out there, and that way it is it's not if I'm using a weekly chart, it's going to use the same 14 bars on a weekly chart, and so that's really what you want to be looking for is a smoothing average period of 14 days out there. Now, when we take a look at how we put this together, what I've drawn in here as you're taking a look at the chart is we want to be paying attention to the 70 and 30 level. You can see for the most of the time, price or the relative strength indicator is traveling with inside that. If it gets above 70%, it's indicating that the whatever chart it is that you're looking at is moving into overbought territory, and there's likely to be some type of correction. That correction can just simply be moving sideways. You can move sideways for a period of time and work off an overbought condition, or you can just simply retrace. Doesn't give you an idea for how the retracement will be. That you would go ahead and use other tools. Likewise, when you see it traveling below the 30% line, that's an indication that the equity that you're looking at or the chart that you're looking at, that it's in an oversold area, and that at some point in time you can expect that would be worked off by either moving sideways or by just simply, bouncing up, retracing up. Now, when you get to extremes, and there are some times where things will get to extremes, when you start getting to a 90 level or let's say a 10 level, most times people are, as he taught in his book, most times he's looking at 20 or 80, the 20 or 80% level. But as I've gone back through charts, I think what you're really looking for is 90 or 10. And when you see that, then you really start to take a look at patterns to be able to play either the overbought and short something or oversold level, because those are basically extremes out there. We're not going to do that today, but I would suggest I'm giving you that information so that you can go back and maybe apply it to some charts that you either trade, you're interested, or looking at, and maybe go back to the history and see what happens when you can find an equity or a chart where you get a overbought condition where you're above 90% or oversold where you're below 10%, and see how long it takes before all of a sudden the market reverses. Now, what we're looking for here is we're looking for divergences. And the divergence that we're looking at is we're watching price move down here. That is this black line. So I'm just simply watching price, just simply lining it up with the relative strength indicator. As price is moving down, it means that it's losing strength. In this case here, and when it's traveling in between the 70% and 30%, it's nothing more than normal activity. At least the way that I look at it. What you're looking for from a divergence standpoint, so we can see that price is moving down. We can also see that the indicator, if I go back to just simply this day here, I could have gone back up to here. So I could have drawn the line all the way from up here. So it would have been down at this high point here. So either way it works. So from here to this low as it was coming in, as the market was coming in, you were below the 30% level, but everything was moving in the same direction. So there was no divergence other than what this was telling us was that in the case here of oil, it was in oversold territory. When we see the divergence that we see is where we see relative strength now picking up. So if we take a look at the low that came in here, this happens to be the June 4th candle, and we know in June 4th there was quite a move in our markets here to the upside. When we take a look at light sweet crude, you can see that the relative strength inside it was actually getting stronger. So that's moving from this red line showing that you were making now higher lows here. Yet price was moving down. So price is moving down, and the relative strength is getting up. And not only is it getting up, it's getting back inside the area where it's no longer oversold. And so then what you're looking for is now you're looking for some type of signal. And to me, there's no better signal than what the bulls and bears of the market express to you in a candle pattern formation. And anyone have sound? Okay. Geez, Jack, I think the sound is fixed out there. And so what we're looking at here is you're looking for some type of, in this case here with the market at the lows, you're looking for some type of bullish candle configuration. And that is exactly what you had occur at the June 22nd level. At June 22nd is what's referred to as a piercing candle. Piercing candle, it's not a bullish engulfing, but a piercing candle is bullish. It's coming at bottoms, and it's where you pierce more than 50% into the prior session as lows are being made. So that was, you're looking for a bullish signal here because you had no bullish signals. You had no other bullish candle signals. You have price moving down. You have the relative strength moving up. And it followed up with a couple of different tests here. Number one, this happened to be a swing point low in crude June 22nd, 376,000 contracts. Price actually moved back down into it to test it one more time. 253,000 contracts were going against 376. So what this also gave you was a failure on price and volume. You still had the relative strength moving in the right direction here, making higher lows. And then that next candle truly gave you all the bullishness that you needed with what's referred to as a bull sash candle. Bull sash just simply means that it opens up just above the close of the prior session and just simply moves higher. So here's a situation where you can, and I'll show you a few more equities, and as I say, we may have some time here just simply for some of you to go ahead and throw out a chart. We'll just take a look at it and see if there's any divergence anywhere. But this is one use for it. And I think this is a really great use for it because what you're always looking for, one of the better trades out there is try to find some divergence because the divergence is going to resolve itself in a direction. In this case here, where you're seeing price get back inside the normal range in between 30 and 70, it's no longer an oversold condition. It's telling you, it's ready to resume now, especially because you got some bullish signals. It's ready to resume moving higher. And that's a way to be able to utilize the relative strength indicator. If you can see, if we take a look at now, let's move on to just so that we take a look at oil, and then we'll move on to some of the other charts out there. But if we take a look at oil, there's been two time periods here coming back to the August 7th level where we've seen crude move in what I'll call a sideways box range. In this case, and when you take a look at sideways box ranges, one of the ways to determine the level that it will trade to when it breaks that, it's going to be the high and low of the box. In this case here, I don't have my calculator handy. Maybe somebody can do it for me. Maybe somebody's got a quick calculator, so I don't have to put up a spreadsheet. But if you go to the high of August 8th, it's 94.72. So maybe somebody can take 94.72 and subtract the low, which is 91.71, which was August 10th. Maybe just type that into the system if you can. So 91.71 was the low, and at 94.72, 301. Thanks, Mike. So 301. So what you can do is if you took that $3 and a penny and added it to the top of that box, which was 94.72, so that's easy. That's going to be 97.73. That is basically where price should travel to. In this case here, it actually got up to 97.85. You could almost say that the box range, is almost got all of this in here, but it gets up to 98.29. So what it does is it gives you a pretty good idea for where price will travel to when it breaks through that box. So if we take a look at the current box range that price is traveling in, I'm using the high of August 23rd at 98.29, and I'm using the low of the box, which is the August 30th candle, at 93.95. That one I did the calculation at a time. So $4.34. So I suspect that what will happen is if you actually take 434 and add it to 98.29, let's see, that would be 102.29 and another 35, 102.60 or so. So 102.60. Well, the interesting thing is if you take a look at that, the 102.60, what does that do? That gets to our first level of the A to B equals CD up here at 102.54. So I suspect that if gold breaks to the upside, it'll complete the A to B equals CD pattern. If we take a look at the relative strength indicator in here, there's nothing unusual that's going on. There's no reason for oil not to at least complete that version of the pattern. It doesn't mean that you're really looking for a break of this consolidation box. It could just as easily pull back by about $5 underneath the 93, 95 level. I'm just simply showing it here on light sweet crude because of the setup, but you can utilize this box range system on any equity. You can use it intraday. Most certainly, if you see a sideways consolidation box that's setting up, just go ahead and set up your high and low. You'd like to be able to see other patterns that, in this case here, what we do have is a confirmed A to B equals CD up. Our B point on light sweet crude would be the July 19th date where you had 192,000 contracts, and when price got up and closed above the B point, it did 194,000. So you had 194 going against 192. It still is a confirmed A to B equals CD. If you come back here, you've got 280,000 contracts on August the 14th as well. So it does appear to me that light sweet crude should resolve itself to the upside, and being in a sideways box, somebody that would want to take maybe a little bit more risk, what you would want to do is you'd want to perhaps take that long position. I think that is the UCO, but I'm not sure. You have to look. It's either the UCO or the SCO, and I think the UCO is the long one. You could take it as price move down to the bottom of the box because your stop here would be a close below the low of this consolidation box. So close below 93, 95, and likely you're wrong on the trade out there. So there's two different technical trading patterns that really haven't shared with you in the past, but thought that it would be a good thing to do here today. And that's why we did that. So let's go back to let me see what else I had let me flip through the presentation here real quickly. Give me a moment. Let's see. No, it was everything there. Okay, so let's go take a look at. Let's go take a look at our current charts here that we've got. So our current holdings. So let's take a look at the bad news. Let's get the bad news out of the way. First, we had a 0.5% risk on a short trade in Panera Bread. It's now moving up into a over overbought area, happens to be above the 70% level. Last time that it had that was back in February 7th. I'm not saying to short this stock. In fact, quite the opposite here. This would be a stock and equity that we would look at entering if it were to pull back. So the pattern failed here. There was a 0.786 Gartley sell, as well as this high volume downdraft day, which was taken out. The way that it was trading yesterday was really looking great. It was almost a shooting star candle up until the last couple of trades in the day that pushed it up just a bit, but it sold off yesterday. Was certainly looking good, and today, ba-boom. Volume really right from the get-go. So all of the resistance areas with inside Panera Bread have been taken out, and this would be another good momentum stock. And will be something that I may add to the list on the long side here, coming into Friday, if the market in fact greets us by moving down into Friday's session. So Panera Bread here has changed from what once was a short. It is no longer a short. It is absolutely a long position. Now, what it did move to today, it did an expansion. When a 0.786 Gartley pattern fails, what it will often do is turn into a 1.272 butterfly or a butterfly pattern, either 1.272 or 1.618. And in one trading session, that's exactly what Panera Bread did. It got a little bit above the 1.272 level, which was 167.19, where it's basically trading right now. So this would now be a decent equity. In my opinion, this would be a decent equity to be long, especially if it pulls back on some lighter volume out there. So that is the bad news out of the way. Let's go take a look at, there's two pieces of bad news. You can't get it, we have our option trade that we were in, Great Basin Gold, which just simply continues to get worse each time. They certainly, was the reason that we took this trade and used the option trade. For those of you that aren't familiar, what we did, we use a 1% or less risk on any trade that we use when I'm taking a look at equities that are trading less than $1. What we will do is we'll put the entire 1% at risk. So in this case here, I think it was around 60 cents or so when we bought into a Great Basin, and $10,000 in capital, you would take 1% of that, $100, and you divide the price. In this case here, 60 cents, 100 into the $100 to tell you how many shares you would buy. And the idea was to put the entire trade at risk, so it was an unexpired option. That unexpired option continues to get stinky as it moved down, as you can see, to 9 cents today. We'll just simply play this one out and see if there's any potential good news on the horizon on there. But that was an unexpired option trade that we did on Great Basin Gold. Let's take a look at the trades here, the two trades that we are in. We've got Great Panther Silver. Great Panther Silver today, we came close to getting stopped out for the remainder of the position that we have. We still have half of a position, 0.5% risk still out there. Our stop was 206. Our adjusted stop was 206. It was within the average true range out there. It actually, the equity got down to 208. So, and it is, it's continuing just to hover here. Where there was a bearish engulfing pattern that completed after it ran into this other resistance candle here. That was a shooting star. That's a bearish candle. So it did what it was supposed to do. But as we take a look at the equity, if you take a look at that shooting star, it had 780,000 shares. And as that area was being tested with over 1 million shares. This wants higher price. It absolutely wants higher price. That doesn't mean that it can't pull back, and it really wants to get all the way up into here, which is the candle from February 29th, which is the 261 to 294 level. It's just that when an equity makes a 1 to a 1.272, which is close to what it did, A to B equals CD, and comes into a resistance area, and then creates another resistance candle, which is the bearish engulfing candle out here. Let me try to open this up a little bit further. What I was really looking for yesterday was whether or not it was going to close lower. Let me get rid of this line here. And what you can see yesterday, it did not close lower. The close from the prior session was at 213, and yesterday's close was at 216. So with it not having a lower close yesterday, that bearish engulfing candle wasn't confirmed, and so As far as what we'll do with the stop on this right now, I'm uncertain, but we'll leave it at 206. At least to protect right now the profits that we have in this. But this stock here, this equity, wants to first get up to this level, which is that 261, 294 level. But what it really wants to do is it wants to get all the way back here. There's the high volume bar that you're shooting for, which is 460 to 499. That'll take some time to get back there, but it is a good looking chart here. If you take a look also at the relative strength, not that there in this case here there was no anomaly, but just simply as it was getting into sold territory, as it bounced out of there, it certainly gave you a bullish candle here. It gave that bullish separation line. Let's take a look at the UNG chart as well. And if we take a look at UNG, it's having another good day today. Volume not as spectacular as yesterday, and getting up into that 0.618 level. So when you take a look at this was a Gertley buy pattern on the daily chart, and the normal level of a move inside a Gertley buy pattern is going to be to that 0.618 retracement level, and that's the 0.618 retracement of the high, which is off of the July 31st high all the way down to low. So that's your A point. This is your D point. That's A, B, C, and D here. So it's your A to D point, and you can see 2061 is the exact 618. It got up to 2065, trading up towards its session highs right now. The volume and the gap up from yesterday says that we should have really good support at the bottom of the gap, which is the $19.55. What UNG also did yesterday was it took out resistance, and old resistance becomes new support. The resistance in this case here was the shooting star candle. That shooting star candle was really right here on September the 4th. Was that the? No, I'm sorry, it was right here. I was the September the 6th candle right there. So this once this high was taken out, which was done yesterday, the actual resistance in this case here, I'm seeing the resistance right now because of this gap. The support, I apologize. The support now should be the low of the session from September 11th. Part of the reason that we're in this trade as well is because of the seasonality aspect of it, but we want to be able to watch volume. We want to be able to see if this possibly gets into any kind of overbought condition. It certainly hasn't at this stage. And the ultimate pattern that a Gertley sell or buy turns into, in this case here, this is a Gertley buy pattern. I'm going to go ahead and erase it off the screen. But the ultimate pattern, the extension pattern that this turns into, is really a new A to B equals CD up. And that is what I'm looking for here. And the new A to B equals CD, this, which is called our X point here, that really becomes our A. So I'll just go ahead and mark this in here. So really this becomes our A point. Forget the sorry about the arrow. Just excuse the arrows. This is going to become our B point right there, and then this is becoming our C point. So try not to confuse you. The Gertley itself there was a large move in this direction here, so we had to move from off of lows to highs. The Gertley pattern was forming an A to B equals CD, a retracement pattern back into a leg that in this case here was moving up. So here was an A, B, C, D, and it happened to be also at the 0.618 retracement level. What the ultimate, when this pattern works then, what this really is doing for you is really setting up your possible new A to B equals CD up. So as we take a look at that, I'm going to go ahead and erase the Gertley pattern. I'm going to go ahead and erase the retracement levels. Erase this line here. And so now what this may be setting up for us is the A to B equals now C to D. And what that would do is that would take us to the 2492 level inside this equity, UNG. And 2492 is going to take you all the way back here to this open gap. Now, the problem with that is the reality is the gaps on these ETFs for something that's trading in essence around the clock, the futures market, are not necessarily real gaps. Now, in this case here, it was January 10th and January 11th. So this gap here, even though it looks like that's what it's doing, it's just simply because this ETF's not trading while the futures contract is. But it does look like this may be making a 1-to-1, at least a 1-to-1 A to B equals CD. So I do want to stay with this position. We did move our stop up today above the I don't recall what the exact price was, but that is on the existing trades that we're in right now. Let me take a moment and go over to some of the other trades that we're looking at. I don't know if I had anything here. Give me a moment here. Let me see if I had anything here that showed divergence. I don't think I do. So let me show a couple of other stock charts here using the RSI indicator and showing some divergence. Happens to be a couple of the trades that we're taking a look at right now and entering. Not that they're at a diverged area right now, but one of those is there's three out there that we can take a look at: DVA, C-Trip, and Michael Kors. So let me put those up on the screen here so we can take a look at that. Let's start with DVA. DaVita, I believe, is the name of the entity. Here's the stock chart, and what we're going to do is identify the areas where there was divergence. So just like the trade that we're taking a look at, light sweet crude. Here we have price clearly moving down, off of this area here, the swing point area, let's say August 9th, down into the lows of September 30th. And what you can see is you've got the relative strength indicator here moving up. Now, you can see it was in oversold condition. This black line here represents the 30% level. I don't have it going back all the way. But you can see that, got into oversold condition. Market still continued to move down, but it was moving down in price, but the relative strength indicator was doing what? It was moving up here. And if we take a look at DVA, if we give me a second here, let me just go back. And what you actually had occur, let me try to blow this up for you. So what you had occur, this set of three candles right here, oftentimes you see me mark our charts up, and you'll see me put down a evening star or a morning star. A morning star happens to be a three candle formation, and three candle formations actually are stronger than a single candle formation like a hammer, or a double candle formation like a bullish engulfing or a bearish engulfing. Just simply, it took three sessions. But what it's really showing you a change in psychology. That's what candles are used for, is to help you understand the psychology of the markets, the psychology between the bulls and the bears. In this case here, this area, which happens to be the low, so it's a three candle session. You've got this larger body right here moving down. Market moves down even further. Price here gaps up a little bit above the close. So it's these three candles right here that set up the morning star. It says that your support should be 59.14 on this equity. You then had the relative strength indicator. We saw the divergence there. So your candle pattern to go ahead and enter the trade was right here. So here's an example of using this tool here, and again, it will work on any charts intraday or what have you. So here's an example of where you're looking for divergence, and then you're looking for the signal. And the bulls and the bears will always give you the signal. They'll give it to you in a candle formation, and you can't hide from it, because the candles have been around for 2,000 years, and they've been used to make decisions like this all along. Let's take a look at C-Trip here. CTRP is the ticker symbol. That also has some divergence on it. There we go. So let's take a look at this equity. It's pulling back today. You can see here we had price moving down. You can see it was below the sold area. So you're below the oversold area. Price is moving down, yet the relative strength indicator, as it's coming up into lower prices, doing what? It's moving up. You've got higher lows here. So you've got higher lows, and that is on C-Trip. And so on C-Trip, if we take a look at the candles out here, the only time that it really gave you the candle confirmation would be as it closed above this bearish engulfing candle. So down here in the bottom, it did not give you any bullish signal right in here. Yes, price was moving up, but it wasn't a bullish candle signal. There was a bearish candle signal right here. And this is important because in this case here, this bearish engulfing, you did have price that, number one, did not close lower, so you didn't really have the full follow-through confirmation that you look for. But you also knew that your resistance area was going to be the top of this bullish engulfing candle. And as soon as you had price close above that, once you get above an area of resistance, it should become support. And so you did have a signal when you had that breakout there on C-Trip. The last one that I was able to quickly identify for you is on Michael Kors. That's a relatively new IPO. And so because it's a relatively new IPO, means you can't really utilize the RSI right away because you need at least 14 sessions, and you prefer to have a little bit more time than that. But let's take a look at Michael Kors as soon as I can find that stock chart here. There we go. And so we'll take a look at some divergence that we had out there. So you can there's a couple of them. So this happens to have two. And again, the symbol is KORS. You've got stock. You've got the stock moving up. It's in overbought area. Of course, when you've got something that is a new IPO, probably overbought isn't going to be as important as an equity that's been trading for years. But nonetheless, you did have price moving in one direction and the relative strength moving in the other direction out here. And what you had is this candle right here, which was on March 14th. March 14th, it went ahead and gave you a bearish engulfing candle, and you ended up getting confirmation with lower closes. The lower close actually came in on the second session after the bearish engulfing pattern out here, and price moved down, into an area. It almost got right down, got to almost that 30% area, but you can see a little bit of divergence here. You have price moving down, and you have the equity showing stronger relative strength, and it was doing that in this area here. It happened to be a bullish engulfing candle. That was right here on the date of June the 5th as price was making this low. And when you have a bullish engulfing candle, in this case here, as it did on June the 5th, and it engulfed really these prior two sessions, it's really the low of any sessions that are engulfed that would become your support level. That happened to be this low right there on June 4th, which was at 35.95. That had 1.9 million shares, and that got tested with 3 million shares. It got tested with 3 million shares really on 2 days, but this area here held, and you had divergence with regard to price moving lower and the relative strength picking up. So that is that's what I have for you for today's session. Again, my expectation here, we'll see how it plays out, would be that the market would move down into Friday. Certainly we'll be paying close attention to how the market reacts to the release of the FOMC or Bernanke speaking tomorrow. So, we'll just simply watch how that plays out. And with so many other patterns that are out there that are completing, whether it's the euro, whether it's the U.S. dollar index, everything at this stage seems to be setting up for a market that would move a little bit lower. So is there anyone that has any questions out there? I'm happy to answer those. We've got, probably about another 3-4 minutes or so. And as always, feel free to send me an email with any specific questions that you have. But I suggest that, for those of you that have the trading tools, go take a look at using the RSI and look for those anomalies. Just remember, identify the 30 and 70% level, use a 14-day smoothing average versus whatever might default in your system, and look for anomalies. Not divergences, not necessarily anomalies, but look for divergences out there. And if you run across some charts and you're looking at divergence and you would like my opinion, please go ahead and get in touch with me or give me a call or send me an email. All right. Don't see any hands out there. So thanks for your time this afternoon. Have a wonderful evening, and I look forward to seeing you by newsletter tomorrow morning or on the radio show. Have a great afternoon, folks. Take care. Bye-bye.